Palo Alto Networks closed regular trading at 300.48, up 6.67%. Then after hours, it popped 11% to 329.94 before fading. Beat on every metric, stock jumped, then dropped, because the positioning was already extreme before the print. That pattern, initial pop, then fade, determines whether Broadcom, CrowdStrike, and Lululemon follow the same path this week. I am Daniel Reed. This is Market Lens. Let us start with Palo Alto Networks. Revenue of $3 billion, up 31% year over year, above the $2.94 billion consensus. Non-GAAP EPS of 85 cents versus 80 cents estimated. Next-generation security ARR hit $8.1 billion, up 60%. Remaining performance obligations, the backlog, reached $18.4 billion, up 36%. Every metric was either at or above expectations. The stock closed the regular session at 300.48, up 6.67%. During the day, it traded as high as 302.95 and as low as 283.80, a 19-point range into the print. That is a market that was already pricing the outcome before the release. After hours, the stock initially surged 11% to 329.94 before the buying dried up. The spike and pullback pattern reflects positioning, not fundamentals. This is not a fundamental problem. Palo Alto is firing on all cylinders. NGS ARR growing 60%, RPO expanding 36%, the platformization thesis intact. The issue is positioning. The stock ran 65% in May alone. It is up 63% year-to-date at 166 times trailing earnings. The options market had priced a 9 to 11% implied move. When the actual report was merely very good and not spectacular, the marginal buyers stepped aside. The read-through: cybersecurity demand is real, but the easy money was made before the print. This is the pattern to watch for Broadcom and CrowdStrike tomorrow. Ulta Beauty was the cleanest beat of the night. Earnings per share of $7.74 demolished the $6.86 consensus by nearly 13%. Revenue of $3.16 billion beat the $3.09 billion estimate, up 10.9% year over year. They raised full-year GAAP EPS guidance to $28.36 to $28.80. The stock jumped 5.43% in extended trading to 521.95. Ulta worked because the setup was different. The stock had dropped 1.6% on Monday and was down again during Tuesday's regular session. Skepticism was priced in. When the company delivered a clean beat, EPS surprise of 12.8%, revenue beat of 2.3%, raised guidance, the stock re-rated instantly. CEO Keisha Steelman cited broad-based growth across all channels and categories. Fragrance, skincare, cosmetics, all growing. The premium beauty consumer is not pulling back. The contrast with Palo Alto is instructive. When expectations are already embedded in the price, a good report is not enough. When skepticism is the baseline, a good report triggers a repricing. Hewlett Packard Enterprise reported the biggest beat of the cycle last night. Revenue of $10.68 billion, up 40%. EPS of 79 cents, up 108%. Record backlog in AI servers at $6.3 billion. Management pulled forward their fiscal 2028 targets. The stock did something unusual today. It opened at 64.25, a 35% gap from Friday's close of 47.37. Then it faded through the session, closing at 54.39, up 16.26%. That is a $10 intraday reversal from the high, the biggest single-day gain in company history, and it still felt like a letdown. The fade does not invalidate the thesis. HPE's AI business is real. The $6.3 billion AI pipeline includes 61% from government and enterprise. Sticky, long-duration contracts. Non-GAAP operating margin expanded 530 basis points to 13.3%. Bank of America raised its target from $38 to $80. But the hard reality is the stock doubled from its October low into today's open. When a stock doubles into earnings and then gaps 30%, the institutional reaction is to trim. The pattern, run-up, gap, fade, is the same one we saw in Palo Alto tonight. Dollar General and Victoria's Secret both reported this morning. Both beat. The market treated them differently. Dollar General earned $2 per share, up 12.4% year over year, 2 cents above the high end of guidance. Revenue of $10.8 billion, up 3.4%. Same-store sales up 2%, customer traffic up 1.4%. They raised full-year EPS guidance to $7.20 to $7.45. The stock closed down 2.79%. The market's logic. The low-end consumer trade-down has already peaked. Same-store sales of 2% is below the 4.3% they printed last quarter. The CEO transition from Todd Vasos to J.J. Fleeman adds execution risk. A beat and a modest guidance raise was already discounted. Victoria's Secret told a different story. Revenue of $1.56 billion, up 15.3%, a 2.6% beat versus estimates. Adjusted EPS of 60 cents crushed the 32-cent consensus by 90%. Same-store sales rose 13%. They raised full-year revenue guidance by $200 million and operating income guidance by $120 million. The turnaround CEO Hillary Super is real. 4 consecutive quarters of positive comparable sales. Double-digit growth across the Victoria's Secret, Pink, and Beauty banners. The stock surged as much as 34% in pre-market trading on the news. The consumer is bifurcating. Dollar General serves the sub-$50,000 household, and that consumer is stretched. Credit card delinquencies at 2008 highs, consumer sentiment at 44.8. Victoria's Secret serves the mid to premium consumer, and that consumer is still spending on discretionary categories. Both companies beat. Only one got rewarded. Credo Technology and Science Applications International rounded out the week. Credo reported revenue of $437 million, up 157% year-over-year, beating the $432 million estimate. EPS of 1.16 beat the 98-cent consensus by 18%. Full-year fiscal 2026 revenue reached $1.3 billion, up 206%. The company guided next quarter revenue to $465 to $475 million, above the $463 million street estimate. The stock dropped 9% in overnight trading. This is the same pattern we saw in Palo Alto. Credo had rallied 145% year-to-date into the print. The guidance was good, but not great. The market wanted a bigger guide up. When the bar is that high, meeting it is not enough. The AI connectivity thesis is intact. Credo's revenue tripled this year. The Dust Photonics acquisition closes the optical gap, but the stock needs time to digest. Science Applications International was the quiet winner. Revenue of $1.906 billion beat the $1.82 billion estimate by 5%. Adjusted EPS of 3.23 beat the 2.26 consensus by 43%. EBITDA margin expanded to 11.6% from 8.4%. They raised full-year guidance. The stock was up 7.7% in extended trading Monday. SAIC works because nobody is paying attention. Government IT services at 12 times earnings with a $22.9 billion backlog and a $1 trillion defense budget tailwind. The margin story is real. Management is cutting low-margin contracts and rotating into higher-value work. The market is starting to notice. 8 reports, 8 beats, 3 distinct market reactions. 1. When expectations are extreme, execution is not enough. Palo Alto, HPE, Credo, all beat, all faded from their peaks. The pattern is consistent. Stocks that ran 50 to 145% into earnings need a catalyst, not a confirmation. 2. When skepticism is the baseline, a clean beat triggers repricing. Ulta and Victoria's Secret both jumped because the market was not positioned for the outcome. SAIC was the same story. Ignored, then rewarded. 3. The consumer is bifurcating, not breaking. Victoria's Secret raised guidance by $200 million. Dollar General raised by a modest amount and the stock sold off. The premium consumer has room to spend. The low-end consumer is managing. What comes next matters more than what just printed. Broadcom and CrowdStrike report tomorrow. Broadcom is expected to report $22 billion in revenue, up 47%, with AI semiconductor revenue of $10.7 billion. CrowdStrike is the second largest cybersecurity holding after Palo Alto. Both are priced for perfection. If the pattern holds, even beats could produce muted reactions. The macro context is tightening. Brent crude above $104. The 10-year yield at 4.47 and rising. The VIX at 16 is pricing zero concern. The S&P 500 at 7,600 on a 10-week winning streak. Earnings are still the engine, but the market is becoming selective. That selectivity is the most important data point of this week. Keep your data sharp and your logic sharper. I am Daniel Reed. This has been Market Lens.